Hi everyone, it's Guy Spear here, and I have staying with me David Diranko, who I'll tell the story in a minute, but we're sitting down here for about an hour podcast. He's staying downstairs, and he's in my personal library, which I don't know, maybe someday somebody like Jeremy Stickney will give a tour, but I'm playing with this. I can actually show you what the library, no, I can't show you what the library looks like. It is what it is. I'm going to sit this down here. Hopefully you'll see us while we talk as we sit down. And editor, you can cut this out if you want to cut it out a little bit. But how do I get it to follow you?
I think I have to say that. I have to say something.
Okay, it'll go by face, so you need to get up and let it find your face. Go right in there.
What's that?
Yeah, but now it doesn't want to turn that way, does it? So, there we go, something like that. I don't know if it works. That works, doesn't it? Just so, and you need to come in just. I see.
Can you use that one?
Yeah, just. So you need to come in just a little bit more. I'm going to start again. So, hey everyone, so it's Guy here. I'm in my, is that okay? Yeah.
I think now it's centralized.
So hi everyone, it's Guy here. I've got David Diranko staying with me downstairs, and he's come up for a podcast, and I'm going to do a short introduction and how I met him. And we have our dog here. He's kind of like just here in the background, and then I'm going to ask David some questions, which is going to be fun. So I get investment ideas from all sorts of people, and some are forgive me for saying it, they're very worthy write-ups, but I'm not particularly interested in meeting the person. And when I got David's write-up, I liked it a lot. Now, can you remind me what it was that you sent? Was it Lindeberg or was it somebody else?
I think the initial that I sent was called Stem Imaging, that I also presented at VAL.UEx the first year.
Okay, so it was a German small cap. And anyway, I just wrote back on the email that was printed out for me. I just wrote back saying, David, you should come to VAL.UEx. So the next thing I knew, you were coming to VAL.UEx, I believe.
Yes.
But then I had a really good conversation with you. Why don't you explain your side of the story?
I mean, it was pretty interesting because as I got the invitation, I had never met you before, so I thought maybe we should at least interact face to face. So we got on a call, and I think the conversation carried us all over the place. And as I'm a mathematician by degree, I think we went for 2 hours started at investing, but then moved on over linear algebra and probability theory and all kinds of stuff. And I think that was
fun.
Yeah, that was fun.
So, can you remember, was it me who started asking you about that?
Yeah, I think that's what it was. And then, I mean, I like to, everybody thinks, I think, likes to talk about what he's working on or what he's good at. And then, I think,
and then for what it's worth, I convinced David to do all on his own a write-up on IEX. And he had by then started a newsletter called Contrarian Cash Flows, but in this case I convinced David to share a write-up that he'd not yet shared on Contrarian Cash Flows with my newsletter, and I proudly, I believe, helped David grow his email news list by a number. I don't know how significant it was, but maybe I can just start. Just tell me about your mathematical background and tell me about the work that you did before you started in investing.
Yes, as I said, I'm a mathematician by degree, and as many Germans, I have 2 university degrees. So I started out with my bachelor's degree in business mathematics, which is essentially a mathematics degree with some courses in economics. Then, I mean, the initial idea was when you study math, especially like in Munich, where we have 2 big insurance companies, you either become a portfolio manager at a firm or you become an actuary in an insurance company. And I mean, the actuary path didn't interest me enough, so I decided, okay, maybe I should give investing a try. And I started working as a working student for the asset manager of Munich Re. And I must say I didn't particularly like the experience, which has nothing particular to do with the firm, but the way that most insurance companies manage money is very far away from the principles that we use, value investing and understanding the business, but it's mostly managing the insurance company's liabilities against assets, and there is no particular thought in what securities you actually buy. And it appeared to me to be a very bureaucratic role, a lot of, office politics. If we're 800 people firm, so I think that's natural. So I decided, okay, during my bachelor's degree, maybe the investing world, like the professional investing world, is not for me. Then I thought about what can you do with math, and back then AI was not a big thing in everybody's mouth, but it was there were significant developments, and because machine learning is like statistics at scale, I thought it was a very interesting path and probably a good career path. And then I decided to, after finishing my bachelor's degree, to do a master's degree in applied mathematics with focus on data science. And did study for 2 years, still continued working for the asset management firm, although that was not initially the plan, but they made me a good offer where I could bring my data science skills to the firm. So I continued to work there, but after I finished the degree, I joined IBM as a data scientist to actually work at implementing machine learning algorithms for clients, basically. But all the way from my first experience with investing that didn't sit well with me, I started looking up, broadening it out, and obviously, like as many of us, I read work by Warren Buffett, and that made a lot more sense to me. And yeah, all the last 8 years, then basically trained myself to become a value investor. And it helps to be good in math, so I can handle abstract concepts and learn accounting by myself. Read any reports, try to do simple stuff, made a lot of mistakes, improved, reiterated, applying the scientific method. Yeah, and then over time, got better at it, got better returns. And yeah, over the last 3 years, like the returns in my personal account and my wife's account that I managed at that point were really good. And I recognized that although I work a full-time job, I still spend at least 30 hours a week on top to invest. And at that point it became apparent that it's actually my passion and what I want to do in life. And at that point, unfortunately, I didn't put a lot of effort in it, but I had no network of like-minded investors. And I still have to credit Veronica, my wife, then girlfriend, now wife, that I actually reached out to you, because I always talk to her about my obscure investment ideas, and she said, "Gosh, David, you have to find someone to talk to. I can't handle that talk anymore." And then I said, "Okay." There are many. I read your book. I listened to the podcast, and then I said, "Okay, I just reach out and applied." Actually, the newsletter. The idea was actually something that I copied from you, the Learning in Public. And I said, okay, I can try this. It doesn't cost me anything. And yeah, now I'm sitting here, right? So it's somehow it worked.
So I have multiple questions to ask from that. So when can you name the asset management firm where you worked before?
Oh, yeah. It's called MEAG, MEAG. It's Munich Re. Munich Insurance Asset Management Group. So it's like
that would be Munich Versicherung.
Yeah, Münchner Rückversicherungsgesellschaft.
But it's a separate.
Yeah, it's a separate business.
Yeah.
But I also have like I don't know.
Third-party clients.
Yeah, they have both.
So how did you, then already you figured out that that's not the right way to invest. But how did you come across like these value investing principles at that time? Because the guys at the firm would have been saying, you do this, you do this, you do this, and they wouldn't have directed you to, I don't know, Markel, Berkshire Hathaway, all of that stuff. They would have just said, here's what you want to be doing.
Yeah.
So how did you find your way to that?
I mean, at that point, I must say I didn't have like a front office job, so I wasn't part of the investment team. So it was a middle management job, so where it's more about pricing derivatives. Because with a math background, I mean, you price derivatives, you look at options models, etc. I think like I'm just a curious guy, I think, and I thought, okay, I mean, if you type in investing or like famous investors into Google, you figure out Warren Buffett pretty easily.
At that time.
Yeah.
Not at my time, by the way.
Oh yeah, I think that's true. Yeah, no.
My time, I had to go down to a bookshop and see what books I could find.
Yeah.
It's just amazing when I think about it. I went to a bookshop and I looked around the books to see what I could find.
Yeah.
And I picked up all sorts of other books, like Fibonacci on bonds, I remember, and all sorts of stuff. But the Intelligent Investor, I mean, I picked it up, but you could just Google. And so you Googled what?
Oh, I actually don't know it exactly, but I mean, I just wanted to know what paths are there in investing. And I mean, it made sense to me that you buy a business the same way you buy a piece of real estate. And then, I mean, I knew about bonds and how you price bonds, and then you earn a coupon. I mean, most of the money with insurance companies invested in bonds, and you invest for an income. And then you look at a business, and why shouldn't the same principles apply, basically? And
so that's you at the insurance company. And just to rewind a little bit, so to my ear, when somebody says business mathematics in English, I go, business mathematics, what is there? Addition, division, percentages, a few things. Business accounting, so then it's just addition, multiplication, and division, but at least you're talking about concepts of balance sheet and, I don't know, depreciation rates and accrual versus income accounting, but this is Germany. So if they say business mathematics, that means a lot more than that.
Yeah, I think actually the degree is a little bit misleading because it's basically a minor in mathematics. So it's like linear algebra, analysis, probability theory, and you would just have you would have some courses in economics, and in the third year, you would start learning how to price options and the models around that, and that would be like the last year. But there were if you would study pure mathematics, you could choose the same subjects. Right. So it's basically it's a math degree.
And so then you did a 2 years master in machine learning, basically.
Yeah, it was mathematics and data science. So it's an applied mathematics. So it's a third math, a third statistics, and a third computer science, and I mean machine learning courses.
So for your interest, David sent me his textbook, or one of the textbooks, and to print it out, it was like, I don't know, I've got about 4 inches, and I couldn't understand a word, which is a great shame. But we were talking when David arrived a little bit about search algorithms, and for your benefit, David's heard this from me 1,000 times, and it's very basic for him, but I did kind of half an hour listening to the first lecture of a Coursera course on introduction to possibly something like computing, and so just for everybody's benefit, and I don't know, it's interesting for me, we can easily define simple computing problems that would require close to an infinite or practically an infinite amount of computing time to solve. And we talked about checking a network that's only got 1,000 participants, and if you just had a brute force algorithm, it would take effectively more computing power than there is in the universe. So the bottom line is, even with all this computing power around, even with algorithms, the set of possible problems to solve that you could theoretically define, and the set of problems that is solvable with the computing power that we have today, it's like a fractional subset of what there is. You can't even imagine, which is just interesting, I guess. So I don't know if you want to riff on that a little bit and turn it into something a bit more
I mean,
substantial than what I just said.
I think the textbook, I think it was a little bit hard to swallow. I mean, if it's your introduction to math, the theory behind that is more you can in computer science you're generally interested. I mean, first it's about exact solutions, so that's why you have approximation algorithms like in machine learning, for example. So you can always find a good approximation very efficiently in most cases. So, but there is like a question of how to find an exact solution in a reasonable time. And the question is always, can you find an algorithm that has like they call it polynomial time frame. So you can say linear time, or like where the exponent is fixed, like quadratic or cubic, or does it actually take an exponential time to figure? So if you look about the 10 nodes, like it doesn't really matter because you can just go through it. But the idea is that usually you find a problem set in a very small scale, but you want to basically have a solution that scales with the number of nodes or edges when you have think about Google Maps, for example. I mean, and then you want to find something efficient. And if the exponent grows, like you cannot find an efficient solution. So that's the theory behind that. And there are like all kinds of proofs how to prove something I mean, most of the weird thing is like go into theory, you look at a problem set, and then you can prove that there exists an algorithm.
So just a second, you talked about Google Maps. So what kind of search algorithms would you have for Google Maps, or what kind of optimization problems will you have for Google Maps?
I mean, there are many different problems, but I mean the most famous problem that is not solvable or probably likely not. This is still like an unsolved math problem to actually prove that that the problem cannot be solved. It's like the traveling salesman problem. So you have like a network, and you want to find the shortest path to connect all nodes.
Yeah.
It sounds like a very simple problem, but it's still like, I mean, they're like simple networks where you can actually see it, but you have to.
It's easy. If it's trivial.
Yeah, like there are specific types of networks where it's easy, but you want to say like take a random, like just take like a random set of nodes and a random set of edges, and then find the shortest distance.
So this random one is very simple. Random 2 is very simple. Yeah. Random 4, 5. So when does it become?
I mean, the thing is, you can always see the solution with small, but you say, okay, now
when does small become large?
Yeah.
When does small become not small, impossible?
I mean, computationally, it depends on how much computing power you have. But the thing is, if you define the theory behind it is that if you define an algorithm, you say you find one. How long does it take? If you write down the formula, like if you take the steps that it takes, like you say, like you start with start node, then you take that route, you observe, you take the next, like take these steps and look basically at the variables. And then is the variable in the exponent that scales with the number of edges or nodes, or is it in the base? That is the question.
Yes.
And there is very likely no algorithm that you can find that travels finds the shortest path where the variable is in the base. So it's always like an exponential algorithm. So there's basically no significantly better way than just try it out.
But just to give it, so just forget about clever algorithms, brute force.
Yeah.
So I can do brute force with one. So we specify the algorithm is brute force, and none other. And at what point estimating how much computing, like just using a laptop, at what point it would, how many nodes do you need in that specified problem before it would take more than a year for the laptop to brute force it? And I'm just curious because I suspect it's less than 30 or something.
I mean, I think with modern device, I don't know it exactly, so I'm speculating.
But
but it's surprisingly low. I would suggest somewhere between a 10 and 100 it would become
10 and 100 for one computer.
Yeah.
Anyway, so you were doing that stuff, and it was interesting. So just for fun, David was sharing with me how proofs are hard, but proofs are actually how you get to a solution to some of the problems that you would have been presented with at IBM. And then you go from that to looking at balance sheet and income statement. And in the time that I met you first time on the phone or Zoom, you were still working at IBM.
Yes.
And I didn't realize how quickly you'd convert. I thought it would take another 2 or 3 years. I thought it was likely, but so you had Contrarian Cash Flows, and then the next thing I knew, you had left IBM and you'd started doing this full time.
Yeah,
basically.
and I started the fund, and that was basically the why I considered doing full time, which was end of last year. So I started the fund in November, and quit my job end of December.
So, and you have 2,007 subscribers.
Around 2,700, around that. Yes.
And you have, if I'm not mistaken, 1 million in assets under management.
Yeah, something around that.
Have you projected out where and when you'll get to? Do you have target numbers?
Everybody has targets, right?
So, do you mind sharing your targets?
No, I mean it's pretty simple. I mean most hedge funds fail, especially if they subscale. So my thing, I mean the way my wife is involved in business, we set it up is if we keep expenses as low as possible and you don't have that, you can't go bankrupt. I think that's a good way to start.
Yes.
So the way we manage separately managed accounts, so you don't at least have the regulatory overhead and the fixed costs. So we figured out, I mean, if we reach 5 million, like that is sustainable, and 10 million we make income.
Yeah.
And that's the
target basically, which is good because,
yeah.
You know, I've spoken to people very different to you, not recently, who would have said, well, if you can't get to half $1 billion, then there's no point setting up a fund. So,
which actually may be true from that perspective. I mean, if you think about how many people think about a fund, it's like, I mean, at first you have the vehicle, right? That costs money you have an auditor, you have like some kind of operations team because somebody has to do it. I mean, you have an analyst or more analysts, you have an office. I mean, that adds up pretty quickly.
Yeah.
And I mean, it depends also on your fee structure. But I mean, I've put quite some thought and also research on how to structure it well. Because I also think about how can you be mindful or smart with the structure that you use, where you can maybe get an edge when you actually invest. Because if you think about, if most funds think you need north of 100 million or maybe even 500 million to launch, like what is the opportunity set where these managers can invest? This company must be reasonably large.
It's definitely smaller than your opportunity.
Yeah, definitely. And so you think about how can you set it up in a smart way, low costs. You can fish in a different pond. And I think Charlie Munger taught us you have to fish where the fish are, and you find out also like when you go to VAL.UEx, I mean, there's so many smart investors, like very accomplished fund managers. And then you sit there and say, okay, how can I compete with people like that? And my answer is, I go there where there is. I don't want to be the smartest person in the room. I want to be the only one in the room. And if I focus on small companies because I can, then maybe there are professional managers, but likely more retail investors, or sometimes like even companies that are not yet covered or that don't have any eyes on them. And that's where we are now, and that's where I'm focusing at the moment. And
so this year was your first year at VAL.UEx?
The second.
Second.
Yes,
you were there the previous year.
Yes.
So of course you were, because you presented last year. So, so actually you've I can imagine what you said about computer science background, IBM, writing a newsletter. The first VAL.UEx must have been like coming home, actually.
Yeah, that's actually true.
You suddenly found your crowd. And the first VAL.UEx, did you bring Veronica? Veronica is David's wife. Did you bring Veronica with you?
In the first year, not. Like this year, she joined, not the main event, but she was.
Was it what she expected based on your reports, or?
Yeah. I mean, she was definitely excited, but she was. I mean, we've met a couple of the people from VAL.UEx have also become friends and joined us at our home. Yeah. And I mean, we have a very good friendship now with a couple of them, and Veronica as well. And it's just a very.
You don't have to, but So, and I'd love you to talk a little bit about, and I think that you just set this up on your own. You set up with a subset of people from VAL.UEx, a mastermind group of kind of like-minded investors. And, you can name them, not name them, talk about it, not talk about it. But this is me just being curious, by the way, because David's in my office this week and he barely spends any time with me and we can't chit-chat. So this is me doing chit-chat, so I'm curious. And
sure.
It's fun to talk about if you want to talk
about it.
No,
I mean, there's nothing. I mean, the idea is pretty simple. When I joined VAL.UEx last year, the first time, and nothing against you guys, but most of the investors and also at VAL.UEx are old white men.
Thanks. I hate to tell you, you will be an old white man.
I will be an old.
Do I qualify as an old white man?
No.
No, it's fine. You can say it. No. I'm turning 60.
I mean, I thought about. It's not necessarily about age, but it's more like that. I figure out that let's say the problems or the questions that you have at different stages in your career are different.
Yeah.
And I thought they were very inspiring and smart people that are approximately my age, a little bit older, some of a little bit younger. And I mean, the idea was also a little bit selfish. So if I can connect with those people and build a relationship on a regular basis, I'm sure those people will be successful. Yeah. Right, they will be successful 20 years down the road.
People, they're going to die in 20 years.
I mean, there's so many. No. That's not the thought.
So interesting. So I got started in this when I was like 28, 29. So I didn't think of age. And but now I can totally understand why somebody looks at me. And what about people who are 70, 75, 80, where you say, do I really want to invest the time in this person? They're not going to be around for that long. It's better off investing in a young person who's going to be around for another 50 years.
Yeah, maybe, but that was not even the thought. I mean, I love to learn from experienced people. I mean, that's the point. That's why I still feel extremely privileged to be part of VAL.UEx because it's an amazing opportunity. I mean, to learn from now the time that I spent with you.
Because I got, you want to create an organization or a community where every person and we're loyal to the members of the community. We want to create an environment where every member of the community thinks, boy, I'm glad when I joined when I did, because there's such smart people around. I'd never get in anymore. So you keep so, but the new people who tend to be smarter than the people already there raise the bar. So you raise the bar.
I don't know, but the idea was to have something or to start something where emerging investors, emerging managers who I thought were smarter than that I like personally and bring them together. We have a WhatsApp group. It's only a handful of people, and we have a regular call once a month. Yeah. I mean, I try to attend all meetings, and people have a lot. Like everybody has a lot on the table, but it's nice to have like a regular.
Explain this to me, because normally you would consider somebody whose mathematics nearly went into to becoming an actuary, worked at middle management at an asset management company, and then did a master's in data science and worked in solving data science problems. That doesn't fit the profile for me. If you tell me those facts, I would say likely that person is not going to be particularly entrepreneurial.
Mm-hmm.
But actually, you've been extraordinarily entrepreneurial. You started a newsletter. You started investing your own money. You left your full-time secure job. You came to VAL.UEx. You started a mastermind group. So you're doing a lot of things that your classic data scientist probably wouldn't have done.
Yeah. That's actually I take it as a huge compliment, because maybe 3 years ago, I'm still an introvert, but I thought you have to get out of your comfort zone. And I have to credit my wife, then girlfriend, now wife, to it, because she always pushed me to say, you have to move out, you have to show, you have to, talk to people. And I think
she pushed you.
Yeah, but actually, it's a reinforcement. It's a positive reinforcement loop. As soon as I started writing, reaching out, like you get the positive feedback loop, right? People, I didn't expect any, but I mean, my goal for the first year were 100 subscribers on the newsletter, and I mean, I ended up at almost 2,000.
Wow.
And also with VAL.UEx, to be honest, like when I first sent you something, I didn't expect anything back.
Yeah.
And then then you go to VAL.UEx and you say you talk to people and they're actually also interested, and you get more confidence, and then you thought, I mean, yeah, I think I was always entrepreneur. I had the entrepreneurial mind, but maybe not the courage to go. But then in the end, it's all about risk mitigation, also in life. And I mean, writing a newsletter doesn't cost me anything, a couple of hours. I mean, reaching out, I only have to do it. I mean, there is no cost. I mean, the worst thing that you can happen is nobody answers.
Yeah.
And I mean, finally, with starting the business, I mean, you roll the snowball, you figure out a way, and then you think about what is the risk. And it's usually some kind of not confident enough, or like afraid of leaving a comfortable job. And then, I mean, then it's just financials. And I always like played with the thought, oh, I want to start a fund. The newsletter went well. What I do now, eventually I want to start a fund. And also, like, my wife then said, okay, like, I made an Excel spreadsheet and I put our expenses in, and with her salary and our savings and some unemployment benefits that you get in Germany when you leave a job, we can survive for 3 years. David, there is no downside. And then when you have it on the numbers, you say, okay, I mean, now that there are no excuses anymore. And then I basically, got my act together and just did it.
I mean, I think that there are many things to learn from that, but I think that it requires somebody who's willing to look very rationally at one's actual situation, because many people the emotions of the uncertainty, to say rationally, we have 3 years of expenses covered. So we have 3 years of making mistakes, 3 years of allowing random chance to be beneficial to us. But many people would say they'd look, for example, at the beautiful career path that you could have had through IBM, and they'd say, yes, there's politics, but I could end up a area manager or country manager, and it's very secure income, and I can have my weekends, and so and I think there's some people who are entrepreneurial who couldn't be anything else because they're incapable of fitting into an organization. But I actually think that, and I met Veronica, both you and Veronica, you're totally capable of holding down a job in a big organization or in an IBM or wherever else. So you're not entrepreneur by default. You actually took the rational step to do it, which is
more by choice. It's by choice.
So I'm going to go to, and I think that it's very interesting. Hopefully somebody here who's listening to this damn thing with your at home basic production values, whatever the editors managed to do with it, we'll see. But on Sunday, I put a question to you. So on the one hand, rationally, the smaller the amount of money you manage, the bigger your opportunity set. And I said to you, that's true, but you should look at big companies as well, and you shouldn't limit yourself. Maybe you can explain to the listener what I was pushing you to do, and then what you make of it now that you've had a few days to digest.
Yeah, it was a very particular insight from your side. I mean, I thought about it. I mean, just to repeat it, you said I should dedicate at least a fixed portion of my time to study the best business in the world. It tends to be among the most biggest. I mean, say the big rating agencies, like the big luxury firms, to understand the best business in the world, which I was aware of in theory. But the insight that you gave was these businesses, although they might be more expensive, they are not like 50% or 100% better. They are magnitudes better. And that is something maybe hard to grasp, but if you study them in greater detail, you get the right, let's say, benchmark that you can say, oh, this company that I dabble in, that is smaller, it looks good, it looks cheap, but that you can appreciate how big the differential in valuation must be to actually, because these businesses are so much better.
To make it worth your while.
Yeah, to make it worth your while. And I thought about that, and I will definitely take I will definitely study them. I mean, I have studied them, maybe not in the greatest detail, to be frank, but I thought about it. But I mean, I also would like to ask, like to put the question around. And I mean, why did I do it like that? I mean, I also studied Buffett, and I mean, Buffett had his best track record, I think, was his very early years, where he basically went to the businesses that were like quirky and small, and where he had a lot of turnover as well, and just did the scuttlebutt. And I think a couple of years ago, when someone asked him what would he do if he would have start all over again, and he said, I would go to the Moody's manual and just look at that stuff.
Yeah.
And that's why I'm also curious. I mean, and that's basically what I took. But I would also like put it back to you. Like, I mean, what if Guy Spiel would start again now at 20, 28, soon 29 with a small amount of money? What would you when you start over again?
Yeah, that's what Jeremy Stickney asked me, and what I did say is that you have 3 years of runway. I said I'd get a full-time job if I was starting with $1 million. Effectively, you have it in your husband-wife partnership.
I'm asking more from investment, just from
and then I do like maybe 10 by 10, maybe so 10 positions, 10% each, or 20 by 5, so 20 positions, 5% each, because I wouldn't want to. I don't trust myself as much as Warren Buffett trusted himself. But so one question that I have, I don't know the answer to it. So Warren Buffett says I would do small special situations, and but I don't know that Warren has looked at small special situations for a very long time, and I don't know, and I'm really saying this. So it may be that if you were, and he doesn't have the time or maybe the interest to look, it may be that if you were to look at the kinds of small cap situations that you have been willing to look at, he would have said, there's nothing here that's worthwhile because it's been so picked over. And I just want to give you one example. One of the companies that he invested in, which is kind of a celebrated investment idea, is Sanborn Map.
Yeah.
And and Sanborn Map, I don't remember what the asset was, but it was an asset that was carried on the balance sheet that was like 5 times the value of the company.
Yeah.
And he and a group of friends acquired enough shares and then convinced the management to liquidate that asset. Do you remember what the asset was, actually?
I actually don't know exactly what the asset was, but
it was some very valuable, piece of real estate field, something. And I don't think that those kinds of egregious, kind of very obvious things exist anymore. And for example, a long time ago, I mean, believe it or not, 2 or 3 years into my investing career, I mean, you can talk to Whitney Tilson sometime about a company called ISWI, ISWI, which was quasi-fraud, international worldwide gaming, but it was a small cap, and it was a kind of a special situation. Another one that we both invested in together was called, I can't believe that I can't remember the name. It owned a for-profit college called EVCI was the name of the company, small cap company, $10 million market cap when I invested. They owned the company, a college called Interborough College.
Okay.
Some people would call it degree mill, but basically they were helping people who had failed high school and didn't have any hopes in life get a university degree. And it was not Harvard, Princeton, Yale, whatever. It was, but it was a degree, and they did go on to earn far better lives, far better income. So, but I invested. I bought shares straight from the company, which enabled them to convert debt into equity. And I invested at $1 a share, and it went to $7 a share, and then the management voted them. The management, who also controlled the company, voted themselves more money, and I sold out at approximately $3.50 a share. So I made 3.5 times my money. Pretty good. It wasn't 7 times my money. That's life in the big city. But for example, there in that small cap, there are risks that I didn't understand, not just in the business, but in the way the management, once the debt had been paid down and the earnings were on a stable track, took like 50% of their earnings in their own salaries because they voted themselves a pay increase.
Yeah.
And it turned out that one of the guys was going through a divorce. And because I kind of wanted to say, look, we'll give you, I'm a big shareholder, I'll grant you a significant stake in the company where you can make a lot of money in the company, but just don't do it through current share price, current earnings, because you pay taxes on it, the company pays. There's better ways to do it, and let's invest in the business. I didn't understand that he was going through a divorce and he had different considerations, and he didn't care about the value of the stock because his wife would get half of the value of the stock. But if you could just take care, so he had a strong interest in drawing money out. But so I realized that actually in the United States, if you get something that's a sub $50 million market cap, maybe even those are called microcaps in the US. Those are often not investment vehicles for the shareholders, even though they're technically shareholders. They're actually retirement vehicles for the people who control the company. Yeah. And in from Germany, I don't know who sends it to me. I get a glossy publication called Nebenwerte.
That's a little shady.
So you look at the publication and you go, who is paying for this? Yeah. Because it's a glossy publication, and the only conclusion that you can draw is that every single company in there, one way or another, is paying for the publication to gin their share prices up. So that's and I think that at the time, we need to remember at the time that Warren Buffett invested in the 50s, the economy was coming out. Well, it was out of the depression, but stocks had hit all-time lows.
Yes,
people don't. So
it's a different setup or a different time.
So my father would put it like this: you could just open your mouth and cream would flow in. Not that good, but pretty good. And what's my point? And I'm really belabored the point, but the idea is that if Warren Buffett were to actually look at those market cap levels today, he'd say, this sucks. Or maybe he would say, guy, you stupid, they're still around. Or maybe he would say, yeah, you just need to look harder.
Yeah.
But I also think that, in the time when Warren Buffett started investing, so some of the best businesses in the world were, Coca-Cola, American Express were two of them for sure. He invested in Interpublic Group, an advertising agency. At a time, he invested in General Foods. I think we all understand the power of brands these days. But something happened, with the internet revolution. The kinds of businesses that we have now that can grow with next to no capital, Google of the last 20 years. In a way, Warren Buffett missed Google, and I think that's a great. So. So I learned something from you in that conversation and this is where it's good to have mathematicians in your life. So I said, look, it's not that the better businesses are twice as good; they're 100 times as good. And you said something to me. You said, yeah, there's probably a power law in the quality of businesses. Now I don't know how we define quality of business, but power law. And I can't define it or describe it as well as you can, but take x squared, x cubed, x to the 5, x to the 10. Power law is a completely different kind of relationship to numbers, and the idea that that a business could be the quality of businesses distributes as a power law. And actually, I'll stop there and ask you a question. If you're given the task as a data scientist or data scientist background to find a criterion to describe businesses and see if it follows a power law or some other kind of law, I don't know, there's too many variables that are unknown, but could you even start to look at that in some reasonable way?
First I would like to reiterate on the comment you made before. I must push back a little bit. I think these opportunities, they're still around, and I think if you look hard enough, And to some degree, I think I thought a lot about it. Why I think outside of the US is you have a structural advantage if you look at smaller companies because it's cheaper to be public outside of the US. It is private equity and venture capital is less, let's say, profitable. Because the way I think about it is the US is a very homogeneous market. So if you have a good idea in one state, chances are you can roll it out. And that's why why should a small company be still small if it's good? But if you maybe go to Europe, you have, the size of Europe, if you include Great Britain, it's approximately the same size as the United States, and it's even more people, but you have like 20 different languages and 25 or 30 different law systems. So you cannot just scale across borders. So what happens, you have way more fragmented markets, and you find niches and you don't have like venture capital and private equity. Like you have private equity, but venture capital is way harder in Europe because your total addressable market is so much lower. So what companies still tend to do, they go public to raise money. So you can actually find, it's not that they're lying around, but because you have these big opportunities that you can find interesting stuff. Wanted to say why I think that
let's stay there and start with my stupid power law idea because that's just theoretical bullshit. And so I don't think you'll mind me mentioning a business services company in Italy called Lindbergh, and I came to you. So I came to David and I said, look, it's a nice business, but it's not MasterCard, basically.
It isn't.
And, but David's point is they have a distribution network. There are many more products that they can fold on into the distribution network. So they can grow quite a lot, even in Italy, and they can continue to deliver good value to their customers and effectively be a lot larger. Can that company ever? Supposedly, we're in the European Union, and businesses should be able to go cross borders. I didn't look at it as closely as many did, but Eurofins started in France as a very, basically a very good business, testing labs for humans and testing a secular growth for all sorts of reasons. They've crossed borders. Could Lindbergh cross borders?
They've tried. They've tried to set up in France and it didn't work, so they pulled back.
Right.
But the fun, here's where the fun is. The market cap is under 40 million euros, and still, the addressable market in Italy alone is billions. It's not tens of billions, but it's billions.
Yeah.
So, this over the next decade they can 10x easily because it's a small. Within Italy. And if you think about competition, it's actually often like things that I very much like, because if the addressable market is a couple billion, and it's a fragmented industry, so it's not a winner-take-all market. Like, how likely is that a very well-resourced player with a lot of ambition would try to set something up to compete in the market where it can, at best, have like a couple of billion in sales in the services industry? Yeah. So that limits competition, and that is something that actually is very interesting because, we talk. You introduced like power laws and network effects. A distribution network is a network effect. It's, it has a physical component, so you cannot expect to have like the same returns on capital and margins that a software business maybe can have. But what I like about distribution businesses is, I think there is a lot of value and downside protection in a physical asset. And I think, Chris Horn takes it a little bit of another way. Like says, if you have like irreplaceable asset, like an airport, like that is something that you cannot replace. Theoretically, obviously, you can replace the distribution network. But if you can get critical scale in a distribution network, it's very hard to compete. You have to put an irrational amount of money into rebuilding that. And if you have a constrained market, that is a very irrational thing to do. Yeah. And that's what I'm trying to look at it at a small scale, in which I find can be, because the opportunity set is big enough.
We're sitting in Switzerland. I'll give you an example that would come to any Swiss person's mind is there are 2/3 grocery stores in Switzerland. There's Co-op, Migros, and you could say there's Denner, which is the low-cost discounter. nobody's going to, Sainsbury's, you name it, Whole Foods, none of them are coming into the market here. The market is in a way closed, and those are the people who are going to be competing. But a question for you, Luca Delana, who you now know.
Yeah.
So he posts on Twitter today, so it turns out he's got some tax form that he's got to fill out, or tax he's got to pay, or something.
I think I saw the tweet.
So that's good. So
I think
we're supposed to be working with both on Twitter, but the website is only up during office hours, and it's like, that's the fucking point of a website, is you can access it 24 hours a day. And then something like the website is open but only of office hours, but you need to wait your turn. And
I think that's outrageous, but to be perfectly honest...
Did you see that tweet?
Yeah, but I have never seen something like that before. So, that is a very particular... I've never seen something like that before.
So if you just take Lindbergh, they are operating in that kind of environment. And what people say about Italy, and I've now read a little bit about the history of Italy, it used to be that in Venice and Rome they spoke different languages. It was not even the same language. And so it's very, very local.
They even speak still in northern Italy. They still speak German to most degree.
Yeah, it's super absolutely. But even in the different versions of Italian and the different cultural differences. And so, this company may be a Florentine company. I don't know where they're based.
So it's like further north.
Yeah, and they might not even be able to get to Pisa, or to Siena or to Genoa. Genoa was a republic on its own, and it was part of France or part of Savoy. And then you have Venice that was its own republic and owned parts of Greece. And so, you're German, you live in Munich. We understand, as Germanic people, we understand efficiency and low bureaucracy. And now you are yourself investing in an Italian company. And how can you be sure that you're not projecting into Italy? If you understood the difficulties that Lindbergh has to do business, you'd be shocked. In the same way that, for example, maybe with my investments in India, even that I've been investing in India a long time, I fail to understand basic things about how the country runs, because I fill the spaces of what I don't know with what I assume to be true from the countries I've operated in,
It's perfectly fair. I've never lived in Italy, but I'm in Italy